Traders all around the world. This is FXPassion broadcasting you live on YouTube, and this is Forex Trading Course 101. Hello, time to shine. How are you? And remember the three pillars: the strategy and or the system, the risk management rules, and the big one, the psychology part. Hello Miguel, how are you? Happy New Year, everybody. A little bit late, but still Happy New Year. And we are starting today the professional module, everybody. So if this is your first time with us, please go back to the Ducascopy YouTube webinar page and start to watch the basic module first, the beginner module next, until you come to the professional module. Glad you're, oh yes, everybody, this for the first 6 months we are going to have webinars just on Fridays, okay? I don't have much time this year, so for the first 6 months we are going to have webinars only on Fridays, okay? And remember, 90% of traders lose money in the Forex market worldwide, and the webinars are not investment or trading advice. The webinars are for the educational purposes only. And don't trade with money you cannot afford to lose. And for homeworks and or questions, you have my Gmail contact, my Skype contact, and my LinkedIn contact. That being said, let's talk about hedging part 1. And we are going to put down some ground rules first, okay? So before we talk about hedging, let's write some risk and ground rules. Let's talk about this, okay? So we're going to write down risk and ground rules, okay? Hedging is a technique, okay? It's very dangerous if you don't know how to do it, but let's write some risk and ground rules. Number 1, a hedge is for protection. A hedge is for protection and not for profit. Ground rule number 1. Okay, before I teach you what is this, how to apply, how to do. Hello MHB boss, how are you? We're going to write down some ground rules. So a hedge is for protection and not for profit. Okay, I'm going to explain you what do I mean by this. Number 2, okay, hedging is not suitable for all traders, not even professionals, okay? Why? Okay, why? And let's write this down. Hedging is considered and classified as a high risk strategy, okay? So by the regulatory organs. Number 2, most likely all over the world, hedging is not suitable for all traders, not even professional traders. Why? Because hedging is considered and classified as a high risk strategy. Okay, now we are going to write down something a little bit different. So let's put 4 stars, and in reality, this is the reality. Hedging is very safe, but also very misunderstood, and this is why it's classified as high risk. Okay, hedging is very safe but also very misunderstood, and because it's very misunderstood, it's not suitable for all traders, okay, not even professionals. What else? Well, number 3 would be a hedge is a trade. Okay, I'm going to explain you everything, just give me a few minutes so we can talk about these ground rules and risk. And again, number 4, remember these webinars are not trading or investing advice. Number 4, if not done properly, is going to blow your account. Okay, those are some risk and ground rules about hedging. Number 1, hedge is for protection and not for profit. Number 2, hedging is not suitable for all traders. And why is because hedging is considered and classified as a high risk strategy. What is the reality for the one who gets it and obeys the rules and understands and are emotionally stable? Hedging is very safe but also very misunderstood. Number 3, a hedge is a trade. I'm going to explain you in a second. But most important, everybody, okay, don't come crying to me. Okay, remember number 2, number 4 are extremely important. Okay, hedging is not suitable for traders. Number 4, if not done properly, is going to blow your account. And today we are going to talk about how traders, okay, I don't know, of course this is not for beginners, but let's say semi-professional traders and professional traders, they blow their accounts. Okay. Oh, number 5. Number 5. I almost forgot. There is one more. Number 5. Number 5. The hedge is going to increase your risk. And we are talking about risk reward. Okay, I'm going to explain you also number 5. The hedge is going to increase your risk. It sounds how can we say, it doesn't make sense, because I'm telling you that the hedge is for protection, but I'm telling you also that the hedge is going to increase your risk. Now, it's contrary, right? It doesn't make sense. Passion, how is the hedge going to increase my risk and at the same time is going to protect me? Right? So it doesn't make any sense. It's going to make sense. I'm going to explain you everything. Okay? Any questions so far? Any questions so far? A hedge is for protection and not profit. Hedging is not suitable for all traders because it's considered and classified a high risk strategy. A hedge is a trade. If not done properly, it's going to blow your account. And the hedge is going to increase your risk when we're going to talk about the risk reward. Controversial, thank you, Miguel. Controversial, thank you, Miguel, for my English. Okay, everybody, we are on AUD CAD. Do you want to check some other currency pairs that we can talk about the hedging, the strategy, what is the hedge? First come, first is served. So if you want to check some currency pairs, and again, if this is your first time with us, everybody, and you don't quite understand what is happening, what are all the Fibonacci's and the indicators, go back on the Ducascope YouTube channel, find Forex Trading Course 101, okay, and start watching the same over and over and over. Starting, so after understanding maybe a rain of questions. Yes, what currency pair do you want, MHB? Can we stay on AUD CAD? Can we stay on AUD CAD or can we go on some other currency pairs? And remember, first come, first is served. Okay, AUD CAD is okay. So, this is the daily chart, right? We have a down Fibonacci. Oh, this, I'm going to delete this one and delete this one. Euro JPY, okay. Euro JPY. Remember everybody, I'm streaming also on the other platform. You're not going to see all the comments on the YouTube. Euro JPY, okay. What is your idea, MHB? Do you want to go long on Euro JPY? Do you want to go short? What do you want to do? Euro JPY, just give it a second. Okay, everybody. So we have the trend lines, right? Okay, great. I'm going to delete this one. Euro JPY, we have a down structure, if I'm not mistaken. We have a down structure, we have an up Fibonacci. We have an up Fibonacci, original one, A, B, C, D, but we have still a down structure. And the market is reacting, right? The market is reacting to the... We have triple top at the weekly sub-D extension. We have triple top, and the market, it's breaking, looks like. It's breaking the short-term uptrend line. Now, talking about the Fibonacci, let's say if I can do the Fibonacci of the confirmation on the Fibonacci of the confirmation. So, let me see. This is going to be the first one. Blue goes to blue, right? Blue goes to blue. This is going to be the second one. And this is going to be the third one. So Fibonacci retracement, green goes to green. There you go. Okay, now I'm going to delete most of the things. I'm going to delete this one, delete this one, delete this one. I'm going to delete this one, delete. So we are going to have a clear picture. Okay, delete this one and delete this one. Okay, so this is the chart. Not valid anymore. Okay, so this is what we are trading, right? And now we are going to enter into a trade. Now we said that we work with stop loss. Okay, I'm on the daily chart. The market is breaking the counter trend line, and I'm going to enter here. Okay, we're going to sell. Now, before hedging, right? So as a trader, now that I'm learning how to trade, okay, we are going to drop here. This is going to be the A of the Fibonacci. Up in here on the left, this is the A, and we have the confirmed C up in here. This is the confirmed C. Okay, now this is how it's done, everybody. We have the original trade, right? Original trade, and it's going to be what? Entry at, what's the price right now? 120.69, right? Number two, risk. Let's say that it's 1%. Number three is going to be stop loss at, we said I'm going to put my stop loss above the A, so it's going to be 123.845. Okay, now this is my original trade. I'm going to enter short, right? Original trade / short. This is going to be my trade. Now, where is the... So this is the daily chart in here, right? Okay. Now, what else? I need to calculate the volume, right? So number 4 is going to be risk in pips, which equals the stop loss, right? So I'm going to 1, 2, 3, 8, 4, 5 minus 1, 2, 0, 6, 6, 9 equals to 3176, 3176, 3176. Okay, now I have 50,000 in my account, so number 5 volume, right? So I'm going to divide first 50,000, 1, 2, 3 times 1%, so it's 500, right? 1% it's $500. So let me see, 500 divided 3176, 0.16, right? 0.16. So I'm going to enter into a trade 0.16. Okay, so there you go. Entry, I'm going to sell the market at 0.16, 0.16, and my stop loss is, I'm going to ask, not points, but I want the price. My stop loss is going to be at 123.845, so 845, 123.845, 845, there you go. Submit orders, there you go. Okay, so this is our original trade, alright? This is our short, and this is the stop losses up in here, right? I'm going to lose even less, not 500, but looks like 300 something. That was 122, sir. Oh yes, thank you. So I'm going to increase 1, 2, 3, 1, 2, 3, 8, 4, 5. Thank you, time to shine. 1, 2, 3, better. Okay, thank you. Great. Okay. Now, the question is, you need to understand what you're doing. The question is, if for any reason the market, it doesn't matter on the daily chart, 2-hour chart, 1-hour chart, 15-minute chart. The question is, if for any reason the market is going to fall and then reverse and start moving up, right? If you just go with the stop loss, which is okay, nothing, not a problem. Do you always put your orders at market? If I'm in front of the computer, if I'm in front of the trading platform and I see a signal, the answer is yes, Miguel. If I am away from the trading station, then I put limit orders, stop orders, right? Okay. Now, what is a hedge, everybody? And why the hedge, if misunderstood, is risky? A hedge is a protection, okay? And the protection against the loss. So I'm in a trade, I shorted the market, and if I do nothing, and if the market goes against me, which is okay, happens time to time, right? For any reason, and I'm trading this Fibonacci, you know, then I'm going to be stopped out and I'm going to have a 1% loss, which is okay, not a problem, right? We have, you lose 1%. Now, what is a hedge? A hedge, as we said, a hedge is a trade. A hedge is a trade, okay? And a hedge is made for protection, you know? The same way the stock traders, they are using options to protect themselves. The hedge has the same function here. So you said, well, but here is the catch. You need to understand what are you doing, right? So what are we doing? What is the big picture? I'm shorting the market because I have triple top, because the structure is still down, but ultimately I have an up original Fibonacci on Euro JPY daily chart. Okay, so trade what you see. I'm trading what I see, so I'm shorting the market, but in the end I know that sooner or later, okay, I expect, right? I don't know, it's a wrong word, we don't have the crystal ball, but sooner or later I'm expecting the market to reverse and move up, because the weekly, monthly and the daily Fibonacci's are up, right? Now let me check. I didn't check Euro JP5 for quite some time. Okay, so sideways channel. Okay, now we are down. We have a down Fibonacci on the weekly. What about the monthly? Let me see. Okay, so this is the monthly, right? We can expect, because the higher time frame controls the smaller time frame, and this is the monthly chart, this market long term is supposed to go up, right? So before I'm going to hedge, I need to know what I'm doing. Okay, trade what you see. I'm short because I see a triple top, I have a down structure, the market is reacting to the weekly sub-D extension, so I'm short. Now, if I'm wrong, how can I protect myself, right? How can I protect myself not to sustain the 1% risk? Okay, now bear in mind that there are different models on how to hedge, and there are different ways on how to hedge. Okay, I'm going to show you what I'm doing. Okay, now what can I do if I am wrong? If I'm wrong, I need to technically understand where I'm going to put a hedge, right? So where is the place that the market is going to show me that I'm wrong, right? And we have two places. Place number one, area number one is the C. If the market reverses for any reason and goes up to the C and breaks the conformity level, this is one indication that I am wrong about my trade. Now the second level that the market is going to show me that I am even more wrong is if the market breaks the C and also continues its way up, right, and breaks the A of my down Fibonacci. So I have two areas where the market is going to show me that I'm wrong. Sir, isn't the entry short premature because no confirmed downtrend of yet? Time to shine. I'm showing you how to hedge because MHB says that he's short. It's just an example. Okay, so we are going to check later if we are premature or not. Okay, I don't know. I don't have the answer to your question, but I entered short because MHB said that he's short. Okay, and yes, you're right, there is no lower low still. On the daily at least, there we don't have a lower low. We don't have a crown yet. Okay, but this is for the other time. Let's focus on the hedge. Okay, now what does this mean? Rule number one, you cannot put a hedge everywhere and anywhere. Rule number 1. You cannot put a hedge everywhere and anywhere. Okay? You need to have a technical reason that can explain the hedge. Okay, now why do many traders, even professional one, lose money with hedging? Because they don't obey this rule number 1. Okay, you cannot put a hedge everywhere and anywhere. You need to have a technical reason that can explain the hedge. Why is that? We explained in the beginning, a hedge is a trade, right? So, and what does the beginner or the semi-professional or even the professional trader who does not understand hedging, and again there are many ways to hedge and many models, okay? But what can you do? And again, what I'm going to do, everybody, right now, this is wrong, okay? I'm going to jump from the daily chart to the 2-hour chart, okay? I'm going to go, now I'm on the 2-hour chart, and I'm going to say, well, if I'm wrong, I'm going to put my hedge 10 pips above the most recent high. Let's put it like this. Okay, this is what traders who don't understand the hedge do. Okay, I'm going to put my hedge up in here, right? Because if the market makes a higher high, that means that the market is going to reverse and the other blah blah blah, right? Now this is wrong, everybody. Okay, what else is important about, we didn't talk about in the ground rules? You don't want the hedge to be triggered. We talked about that the hedge is for protection. Okay, so rule number 1, you cannot put a hedge everywhere and anywhere. You need to have a technical reason that explains the hedge. Now, 4 stars, you don't want the hedge to be triggered. And again, hedge is for protection and not profit. Okay, and don't worry, everybody, if it sounds complex, we're going to have 5 webinars about hedging. Okay, so rule number 1, you cannot put a hedge everywhere and anywhere. You need to have a technical reason that can explain the hedge, and you don't want the hedge to be triggered. So if I'm going on the 2-hour chart and I put blindly a hedge on the most recent high, right? And I think that I'm intelligent. Okay, where is the chart? 4-hour chart, 2-hour chart, Euro CAD. Okay, now let's go back on Euro JPY. There you go, right? So this is what traders do. They put a hedge, you know, up in here, thinking that this is going to solve the problems. It will not. It will not. What if the market, what you don't want, everybody, you don't want this. The market is going to fall down and move up and hit your hedge. Now, why not? Because this is common price movement, this is common market fluctuation, the market wave. Because if you do this, then you have a problem. And what's the problem? Most likely, look, now we are back on the daily chart. Look where you have your hedge triggered. Now if this happens up in here, you have a problem. What is that? Because the market most likely at your level is going to hit resistance and most likely is going to reverse and still continue its way down. Okay? And we talked in the beginning, the hedge is going to increase your risk. So if you enter in a long trade up here, this long trade is going to have also a stop loss, right? And if you say, well, my initial trade, I'm going to delete a few things, everybody. Delete. My initial trade, in my initial trade I have 1% risk, 1% risk, okay? And let's say that I'm going to enter my hedge here, which is wrong, and I'm going to put the stop loss of the buy. Okay, so this is going to be buy hedge stop loss. This is going to equal whatever, 0.5%, right? Buy hedge stop loss is going to be 0.5%, and if the market hit my hedge and start to go down, which was supposed to do, now I'm going to lose 0.5% of my profit. If the market is going to hit my take profit from my original trade short. Miguel says, I'm short also. Okay, that's not structure high, so can easily be triggered. Yes, sir. Yes, sir. Everybody, the lesson for today, remember, you don't want the hedge to be triggered. Hedge is for protection and not for profit. And remember, you cannot put a hedge everywhere and anywhere. You need to have technical reasons that explain the hedge. Okay? So you don't want your hedge here because can be easily triggered, you know. Now this is one scenario. What else? Why the hedge? If you put a hedge in the wrong place, why the hedge is going to increase your risk? Because the market can go also sideways, right? The market can do anything it wants when it wants. So let's say the market triggered your hedge, right? Went down, hit your stop loss, so you lost 0.5% and then reversed and went straight back up to your stop loss of your original trade. What just happened? Instead of losing 1%, you lost 1.5%. And this is dangerous, everybody. This is dangerous, and this is where the hedging strategies are classified as high risk. And this is dangerous because if not done properly, okay, if not done properly, you are going to burn out your account 2, 3, 4, 5 times earlier. Okay? Any questions so far? And when we are talking about hedging, everybody, these webinars, if you want to learn, remember these are not trading or investment advice, but if you want to learn, if you want to educate, watch these webinars 4 times, 5 times, the same webinar. Okay, in the beginning we were telling you watch the same webinar 1, 2, 3 times to learn what is structure, what is the market wave. Hedging is more complex. Okay, no questions so far, great. Okay, so one last time before we go, one last time, okay, how can you burn or destroy your account with hedging? Okay, how can you burn or destroy your account with hedging? Just as an example, we are in a downtrend, in a downtrend. Let's say that we have an uptrend. Okay, let's say that we have an uptrend, and let's say that we entered here. Just an example, we entered here, and instead of a stop loss, let's say, and we have also Fibonacci, right? This is our A to B. Okay, pay attention to this, everybody. This is how so many traders burn their accounts, or have a big drawdown like 30%, 40%, 50%. Okay, we have an up Fibonacci AB, and of course on the smaller time frame the trader is going to go long, and now that he or she learned about hedging, what he or she is going to do? He's going to put a hedge somewhere in here. Okay, so this is going to be a hedge, not a stop loss. Okay, hedge. Okay, hedge, and this is going to be a hedge slash short. Okay, how can you burn, destroy your account with hedging? Well, the market is going to reverse, is going to hit your hedge, and is going to continue, and is going to do this. Okay, now remember, on the monthly chart, on the weekly chart, and on the daily chart, you have the up Fibonacci. Okay, now your long position is going to show minus whatever. We're going to use simple numbers. Okay, it's going to show you minus 250. Okay, whatever, it's just an example. At this point in time, in here, at this point in time, your long position is going to show. Okay, so here is going to be the entry long, so entry equals long up in here. Okay, there you go. So entry, we entered long. We entered long in here, and we have a hedge short in here, and the market, we are here right now. So our long position is minus 250. Our short position, short, is going to show us plus, plus 120. So we are making money, right? Our hedge, our short position, is going to show us 120 plus. So we are making money, and we are happy because we don't have the stop loss anymore, and we are the man, right? So what does the trader, sometimes professional, who does not understand, or maybe it's not emotionally stable enough, do? And I did this also, everybody, in the beginning. I blew 2 or 3 accounts with hedging. Okay, I'm telling you the truth. I blew 2 or 3 accounts because of hedging, and I did this, everybody. So yes, what trade, the long trade or the short trade? What does the trader do? Close the trade. Which one, the long or the short? The trade that feels good or the trade that feels bad? Which one I'm going to close, everybody? The short one, exactly. So I'm looking at my P&L statement, and I just banked 120 US dollars, right? And what else does the trader do? I mean, I have all the knowledge. I can give classes, I can speak to the president. I'm the man, you know. What I'm going to do? Well, I'm going to look at structure. Let me see. I'm going to look at structure of the trade and the Fibonacci, and I'm going to say, well, I'm going to put a new hedge down in here. This is going to be my new hedge, just for protection, right? Just for protection, I'm going to put my new hedge down in here, right? So short rate, right? Closed slash banked money, right? And I'm happy and I'm the man, you know, and I'm telling everybody, you know, that I'm the trader, you know, and I know that the market is going to move up, right? Because I have the trend and the Fibonacci and the Ichimoku, you know, and the super mega JP Morgan Chase system, you know, right? Yes, correct. And I'm going to put a new hedge, right? So I'm going to put a new hedge, risking, now I'm going to risk 2%. Okay, I'm going to risk 2% on my hedge trade, right? So this is my new area, and I'm going to put my stop loss of the hedge up in here. This is my new, right? Now the market, for any reason, what is going to do is going to go down. When is going to hit the hedge? What is going to show my long trade? My long trade is going to show me not minus 250, but my long trade is going to show me minus 500. It's just an example, but this is how traders lose money with hedging. Background color, this one. Why? Because I just doubled my risk, everybody. Okay? Remember, try to understand this, everybody. I'm using a hedge instead of a stop loss. Okay? I'm using a hedge instead of a stop loss. Instead of me losing 250, I entered with the short trade. Okay? And because this short trade went down, I banked $120, and psychologically I'm happy and I'm the man. What I'm losing sight, what I'm not aware of, my long trade, which should be a loss, down here just doubled. Just doubled down here. So I'm not risking anymore 1%, now I have a 2% risk. Right? And you can say, well, but you also banked $120, right? And yes, this is true. So your loss, passion, is not 500, but it's 500 minus 120, right? And the answer is yes. But the market just hit a new hedge, everybody. Okay? And nonetheless, still, I'm over leveraging my account. I'm risking too much. Even though I banked $120, still my initial stop loss was $250. And even if I count the profit from the short hedge, which felt so good, you know, it's feeling so good to make money. Okay, I risked more than was my initial plan. And what does the trader do? The market goes up and goes down and goes down, somewhere in here. And again, it's just an example. The long trade is going to do what? The long trade is going to show us what? Minus, just an example, minus 750, you know, and the short rate is going to show us, wow, you know, short is going to show us plus 250, you know, and again we are going to be happy, you know. And what we're going to do down here, correct, we are going to close the trade with profit, you know, and we just banked $370 in our account, you know. But again, psychologically we are missing sight, everybody, of the long trade. Please watch this webinar 5 times, okay, because this is where you need to understand that you are not making money, but you are increasing your risk, okay. What's the word, Miguel? Contradictory. Sounds contradictory, everybody, but you need to understand that this is where you are going to burn your account. You are closing just the profit trades and you are losing sight of the negative trade, okay. Now there are various scenarios and we don't have time today. Now let's continue to talk about this. Now what is wrong? Well, number one, a hedge is for protection and not to make profit, okay. So what should you do, everybody, when your first hedge is hit? Stay in the hedge, and this is a rule, stay in the hedge until the market reverses and goes up, back up again, okay. Don't close the hedge just because it's making you money, because the hedge is for protection and not for profit, okay. Now we can play all around and we can go further down, you know, and just for example, right, the trader closed the short trade, banked, and is going to put one last hedge. Is going to put one last hedge down here. This is going to be our last hedge, okay. Happens all the time. Now the market is going to fall down, it's going to hit our hedge, and now it's going, finally it's hit the 14% Fibonacci ratio, found support or resistance, whatever, and now finally the market start reversing. It's just an example, and if you don't quite understand, don't worry, we are going to talk about hedging for the next 5 lessons, okay. Now we are here. What does our long position, we are here, okay, so we are here right now. Let's circle this in yellow, everybody. We are here at the yellow line, okay. Decoration, stroke, transparency, there you go. We are here at the yellow line. Time to shine is asking, in theory you can make profit from both trades if patient enough. In theory, yes. In practice, no. Okay. In theory, yes. In practice, no. Why not, time to shine? The hedge is for protection and not... Everybody, forget making money with the hedge, I'm telling you. You are going to lose and burn your account if you are going to try to make money with your hedge. Okay? It's theory, okay, there are different models, you know, about how to hedge, different ways, percentage rates, numbers, you know, whatever. Now, let's go back in here. We are here at the yellow line. What does our long position is showing? Our long position is showing that we are at minus 500. Okay, And our short position, because the market reversed, our short position is showing us minus 250. Okay, we don't have time today to talk about, oh, this can happen, or this could happen when you sleep or you went away from the platform. Please don't hedge on the 1 hour chart, 15-minute chart, you know, because you need to react. Okay, but you can lose from both. Yes, you can. Yes, you can. Okay, now we are at the yellow line, right? We banked, everybody, 120 and 250. So now this is the lesson. At the yellow line, so, and we're going to end the webinar slowly. So result. We banked 300, what was the number? 370 US dollars, but we have a floating loss of 750 US dollars. This is what you must understand, this is what you must be aware, this is what you must be afraid of. When the market does this, everybody, and we are in between our short trade and we are far away from our long trade, what is the result? The result is we banked $370 closing the hedges, right? The market hit our last hedge, reversed, right? And we didn't close our short hedge, and we are here at the yellow line. And making money felt so good that we are thinking, well, maybe the market is going to fall down, you know, maybe the market is going to fall again. So I'm not going to close my short trade, you know. But look at the result, everybody. Did we make any money? Tell me, everybody, did we make any money doing hedging in this way? Did we make any money? This is where traders lose money. Burn the account, big drawdown, 30, 40. It's not over. Next Friday we're going to continue exactly from here. What does the trader do? The trader, what is the next step? The trader is going to leave the short trade opened and is going to enter, you know, we have, man, the market hit the 40%, I'm going to enter in another trade long down here because it's a good entry. This is going to increase your risk, everybody, even further. You know, again, I'm going to repeat myself. Watch this webinar 5 times. You need to understand what happened here. This is what you must not do, everybody. Okay, this is what you must not do. It looked like that we are making money, that we are the man, you know, I'm the trader, and we told everybody, you know, how we are professional traders and we are making money with hedging in the downside. We weren't making money, we just increased our risk, you know, because we have a floating loss of 750. And of course some of you are telling me, you know, oh, but it's not 750, 750 minus 370, it's the same. If we would have traded our original trade with the stop loss, we would have a 250 initial stop loss, and we would obey our risk reward ratio and we would obey our risk management rules. With hedging, even if we make some pips and money, we are exceeding, we are not obeying our risk management rules anymore, everybody. This is so dangerous. And I'm telling you because I burned 2 or 3 accounts doing exactly this. It's not over. Next week we're going to continue from here. Because our mind is going to start to strategize all different scenarios how not to close a trade with a loss. You know? Now, rule number 1, you cannot put a hedge everywhere and anywhere. You need to have a technical reason that can explain the hedge. You don't want to hedge to be triggered. Hedge is for protection and not profit. Lastly, for today, everybody, rule. When you are wrong with the original trade or with the hedge, you must close the trade with a loss. Okay? And this is why hedging is not suitable for most traders. You need to be emotionally developed. Okay? Because believe me, when this happens, when you are going to make money with the opposite rate and you are in the wrong direction, your heart, everybody, your emotions, your greed will not want to close with the negative. Your greed won't make you to close the trade with a negative balance. Greed just wants to close the good stuff, you know? Profit. So this is the rule. When you are, and me, right? When we are wrong with the original trade or with the hedge, it doesn't matter. Sometimes we hedge in the wrong direction. Why is that? Because a hedge is a trade. You must close the trade with a loss. And what does the trader do? No, I'm not going to close with a loss. I'm going to double up with the long trade right now, or if the market is going to fall, we are going to double down with another short. And what is the result? You are going to burn the account. Okay, everybody, happy Friday, you know. Passion, this is difficult stuff. Yes, it is. Yes, it is. I'm telling you, we are not joking here anymore, everybody. We are not playing around. At the professional level, we have rules and concepts, you know, and models that we obey strictly, no exceptions. You know, you can play around until the intermediate and you can test the basic, maybe also in the advanced, but when you get to the professional level, you cannot play around anymore. Why not? You are going to burn your account, you know. Okay, everybody, see you next Friday. If you are going to learn about hedging, watch this webinar 5 times minimum, okay? And send me questions. Stay strong and trade with passion, everybody. This is FXPassion signing off.